Welcome to the Explainer. Today, we're putting on our detective hats. We're on the hunt for some hidden clues, not in a crime scene, but buried deep inside the market's code.
So here's the big mystery, right? The one every trader is trying to solve. How in the world do you look at all that noise and figure out where the price is actually headed next? It feels like a puzzle, but hey, every good puzzle has clues.
And the biggest, most important clue we're going to focus on today is something called a price pivot. Think of it as the key that can unlock the market's next move. To find these pivots, we first have to know what we're looking for. And what we're looking for are the exact moments the market changes its mind, those crucial turning points.
You know, at first glance, a price chart can just look like total chaos. A bunch of random, jagged lines going all over the place. But if you've got a trained detective's eye, you start to see that there's a structure hiding in plain sight. There are patterns, footprints really, that lead us right to our clues. Now, before we go any further, let's just quickly get on the same page about our basic unit of evidence, the candlestick. Each one of these tells a little story about the battle between buyers and sellers. It shows you where the price opened, where it closed, and the highest and lowest it went. Simple as that. Okay, so with that foundation laid, let's zoom in on our main suspect. What exactly is a price pivot? Think of it like the hinge on a door. The market is swinging in one direction. It hits this specific point, and then it swings in a completely new direction. This isn't a pause, it's a decisive turn. It's what creates those really clear peaks and valleys you see on a chart.
And this is a really critical distinction to make. A pivot is a direct reversal, from up to down or from down to up. A simple pause where the market just kind of goes sideways for a bit, that's not a pivot. We call that a base. A base is all about indecision. A pivot is the moment the decision gets made.
So, how can we be sure that what we've found is a genuine pivot and not just some random market noise? Well, like any good detective, we have rules of evidence. There are two conditions that absolutely have to be met. We've got two unbreakable rules: the return condition, which is all about the reversal strength, and the movement condition, which confirms the strength of the original trend. First up, the return. Now, to understand this first rule, we need a special little tool from our detective kit called the ATR, or average true range. All this really is a ruler. It tells us what a normal or significant price move looks like for that specific market at that specific time. Okay, so this brings us to rule number one. For a peak or valley to count as a true pivot, the price has to reverse with some force. It has to move away by at least one full ATR. Anything less than that, it's probably just noise. So this confirms the reversal is strong, but what about the trend that led into it?
Well, that brings us to our second rule. And for this one, everything comes down to a single number, 3.
This rule is here to make sure we're actually reversing a genuine trend. The move heading into the pivot has to have at least 3 candlesticks all pushing in the same direction. That tells us there was clear momentum, which is what makes the reversal so significant. All right, we've got our main rules. But every good detective knows you have to keep an eye out for the unusual suspects. Those special cases that don't always follow the book but are incredibly important. The big exception here is a candle with a really long shadow. A lot of people call it a pin bar. That long tail or shadow is a huge clue. It basically tells us the market tried really hard to push to a new price, but it got aggressively rejected. That's a powerful signal of a potential reversal right there. And this just shows you how important they are. According to our source material, the levels that are marked by these exception pivots are so significant they can cause a market reaction again and again, even 10 times down the road. I mean, wow, these are the clues that keep on giving.
So, we've figured out how to find the clues. But what's the real payoff for all this detective work? Well, it all boils down to one really cool concept.
Here it is, maybe the most powerful way to think about it. Pivots are the market's memory. The peaks and valleys you identify aren't just random blips. They become historical landmarks that the price will often remember and react to in the future.
By finding these pivots, traders can basically draw a map of the market. They can identify the key floors, which we call support, and the ceilings, or resistance, where price might struggle. It helps them anticipate where the next turn might happen, and maybe most importantly, just helps them understand the underlying structure of the market story.
But this might be the most important rule of all. Pivots are not a crystal ball. They do not predict the future with certainty. What they do is reveal possibilities, and that's where the real power is.
So the next time you look at a chart, don't just see chaos. Look for the hinges, the peaks, and the valleys.
Look for those 3-candle moves and the ATR returns. The clues are all there. The only question left is, what story is the market telling you?